Hi, this is Professor Rujo with Chapter 1, Learning Objective 3 Notes. I grab my pen and off we go. So Learning Objective 3 looks at the financial statements, and it's very, very important that you know these financial statements. Of course, there are 4 of them. We're going to be focusing in on 3 in this particular course in detail. The first 3 that you see listed here are the ones that are going to be the focus of this course. The 4th financial statement, called the statement of cash flows, is an important statement, but it is a very detailed statement that's usually performed in managerial accounting or in intermediate accounting in a significantly more detailed way. And so we're going to save that for later. But things that you have to know regardless is the income statement through the balance sheet. So we're going to be focusing on these 3 statements. Okay. Notice the order of the statements. Income statement is listed first because it's actually the first one that is prepared. From the information on the income statement, the retained earnings statement is then prepared. And then after that statement is done, it flows down to the balance sheet. And you'll see that as we review, that flow is going to happen. The income statement, to me, is an incredibly important statement because it tells you, it answers the question that all owners want to know. Do we make a profit or not? And only the income statement can tell you that. It's always the first statement that's created because it is, in essence, the most important statement to understand in terms of whether a company is profitable or not. So the income statement has, as you see here, and these are forms that don't change. So anytime you need to prepare an income statement, it's going to look very similar to this. The heading is always first. The name of the company is always listed first. The name of the statement is listed second. In this case, the last thing is the time. Now here, this is for the month, because in this case, this particular income statement tells us everything that happened in October of 2017. So from the very first day it opened, October 1st, to the very last day of the month when it closed, these were the revenues of that particular company, and these were the expenses of that particular company in that time frame. Income statements are prepared on a monthly basis, a quarterly basis, and an annual basis, but they will never show you more than 12 months of activity. And you'll understand more as why when we get later into chapter 3 and 4. If you notice here, revenue is listed first. The revenue here has a specific title, service revenue. Now, revenue is a type of an account because all companies will have revenue accounts. But this is a specific name of the revenue account. Service revenue means that the revenue, which is the money they earned from customers, was because they provided a service. And again, a service could be anything from cutting somebody's hair, doing someone's taxes, giving them legal advice, or other types of things like this. So a service is it's paid work, right? You're paying someone to do work for you. And that's this particular company, how they make their revenue. Now, Sierra Corporation in the book is a tour company. They do tours of the Sierra Nevada area in California. And so the service revenue that they've earned in the month of October, which as you see here, $10,600 of service revenue, represents probably quite a few tours that they've done over that 31-day period. Of course, in order to actually provide the tours, they obviously had to have expenses. There's certain costs that businesses have that they need to incur in order to provide customers with whatever they're selling. So in this case, in order for Sierra Corporation to provide the tours, that makes them so a company, right? Because that's what they sell. they're going to have to incur certain costs to provide those tours. Now, the money that they spent on those costs for October and only October is listed here. Okay, just like the revenue, the amount of money that they earned from their customers for the month of October is only listed here. So it's important to understand there are time constraints in these statements. So this is specifically for October. It doesn't talk about anything prior or anything after, simply October. So these are some common expenses. If you notice, the very first expense that that's listed as salaries and wages expense. This is a particular account, an expense account. Again, expenses are a type of account. Salaries and wages expense is a specific account. And that specific account tells us what Sierra Corporation paid for salaries and wages for the month of October. $5,200 was the total cost of salaries and wages for October for Sierra. Another common expense you'll see, the specific account is called rent expense. Now, it's important to understand that most companies do not own their buildings. There are many companies that do, but most don't. So this particular company, as many service businesses, might be renting space or leasing space in a particular area. And so every month that they're there, they incur a rent expense, and that's what's listed here. $900 for the month of October was their rent expense. There's a whole bunch of other expenses that are listed here that we will be going through in significant detail, but these particular names here are names of specific expense accounts. And this is a great saying that I will tell you about that you'll need to remember. Accounting is based, the root word of accounting is accounts. And what you're learning are the specific accounts. Service revenue is a specific account. Salaries and wages expense is a specific account. And here's the advice. You can't do accounting without knowing the accounts. And so it's important for you to spend some time becoming familiar with the names of the accounts. And these are the names right here. These are the types of accounts. There's a big category, revenue. This is the specific account name. Expenses, a type of an account. Expense accounts are types of accounts. These are the specific expenses. In accounting, we have to classify everything as clearly as possible. Okay. You notice it's not miscellaneous revenue because it doesn't answer the question, where do you get them, where'd you earn the money? Right. And I hate miscellaneous expense because what was the expense about? Right? If it was about postage, then it's postage expense. It's not miscellaneous. You know exactly what you used it for, so call it what it is. And that's how accounting kind of looks at things. One important thing to know about the income statement is it starts with the revenue accounts, then it subtracts out all the expense accounts, and the total, well, the difference, not the total, the difference is, in this case, $2,860. So here they started with $10,600 of revenue, money collected from the customers for giving tours. They needed to spend $7,740 to run the business that month. So they actually collected more money in revenue than they used for expenses. And that's what a profit is. A profit is simply the difference when revenue is bigger than expenses. Now you'll see the formal name for a profit is called net income. Okay, so net income is just simply a formal name for profit for a company. So if a company is profitable, it will have net income. What happens if the expenses are bigger than the revenue? And that does happen to companies. Not in this particular book. The first 4 chapters, they're all happy companies. They're all very profitable. But in real life, there are companies that the expenses are much higher than the revenues, in which case it's not net income, it's called a net loss. And so there will be companies that report net losses. And all that simply means is for that period of time, whether it's the month or the year, their expenses were bigger than their revenue. Okay, some definitions here. Again, some things that are super important is, again, we look at specific periods of time. This is actually called the periodicity assumption in accounting. I already told you the difference between net income and net loss, okay? And when we actually know how the company has been doing over time, it makes it a bit easier, believe it or not, to sort of predict what the future might look like. Okay, of course, there's no guarantees, as we all know from this COVID crisis we're living through. But in general, if things don't change, it does provide a pretty good way of predicting how things are going to be going. So the income statement is the very first statement that is created because it's the only statement that tells the owners whether they made a profit or a loss for that semester. Or, I'm sorry, for that semester. Wow. No, for that period of time. Month, quarter, or year. Okay. Well, what happens to this particular profit? Well, the question becomes, and I would ask you, as I do in class, who owns the profit of a company? Right? Well, the owners of the company own the profit. Okay, it's their profit. So we wouldn't be worried about if you were a sole proprietorship and you had $2,860 left over, there'd be no question it's yours. Right. For a partnership, it would be broken into whatever the partners have agreed upon when they started the partnership. But a corporation has owners called shareholders. And a corporation has broken its ownership into many shares of ownership. And so who owns this particular profit? Well, the shareholders own those profits. Shareholders, stockholders are interchangeable words. They mean the same thing. And so the owners, in this case, the stockholders, own that profit. Well, if you made that type of a profit, what do you want to do with it? Just grab it and go? No, most companies want to retain the profit in the company so they can invest it in new assets to make more revenue, right? To sell more stuff. And so the idea of that is what we call retained earnings. Now here's another lesson in lingo. Profit, as I told you, and net income are the same. They're interchangeable. Here's another word that's the same, earnings. So earnings is the same as profit. Earnings is the same as net income. Okay, so earnings, profit, and net income are interchangeable words in this course. Okay, so retained earnings also could be retained income, retained net income, retained profit, right? So how much of the profit is retained, meaning kept in? So to retain something is to keep it in. And the owners would like to keep in or retain most of the profit. However, a lot of companies, this is in the corporate form, a lot of corporations will share a portion of the profits with the owners. And that's what a dividend is. A dividend is simply when a corporation shares a portion of its profit with the owners, which is the stockholders or the shareholders. And that's a dividend. But they don't want to share all of it, they'll share a portion of it. Right? And so as you see here, the net profit is $2,860. That comes from our income statement. They actually are sharing $500 of that. So $500 of this money is going out of the company. It's leaving the company. It's going out of the corporation. Thus, what's actually retained is the difference between the net income and the dividend that's being paid. So $2,360 of the $2,860 profit has been retained, kept in the corporation to invest in assets. Okay. $500 of it has been paid out as a dividend. So that's going into the owner's personal pockets, okay, as people, not as owners of the corporation, but as people, personal pockets. So dividends are subtracted out. Retained earnings are the portion of the profits that are kept in the company. And I asked you, who owns those profits? And the correct answer are the stockholders, right, or the shareholders. So that means that the shareholders will have $2,360 of profit that's remaining for use in the next period of time. Now notice that the retained earnings statement shows you exactly the same period of time as the income statement. They will always match in their time period, okay? Same exact time period, okay? But that's different in the third statement. The third statement here is the balance sheet. The balance sheet is simply a financial selfie of what the company has that day for its assets, for its liabilities, and for its stockholders' equity. Okay. So a balance sheet is a financial statement. It's a very important financial statement, but it simply shows you what's going on as of a particular day. Whereas the income statement and the retained earnings statement show you what's happening over a period of time, a month, a quarter, or a year. That's very important to know. So a balance sheet shows us first what the company's resources are that they own. So assets are resources that are owned by the company. The purpose of these resources owned by the company would be to help generate whatever it's selling, okay, products or services, depending on the company. In this case, Sierra Corporation does tours, so provides services. These are all specific asset accounts. So assets are a type of an account, and these are the specific names of asset accounts. And again, you have to know the names of the accounts because you cannot do accounting without understanding the accounts. And so all of these 5 here are specific asset accounts. Now, cash is simply that, the amount of cash the company has in its bank. I mean, when we say cash, it's not just like loose cash around the office. It's whatever's in its main bank accounts for the company. So when you start a company, you open up a bank account for your company, and it's whatever's in there is your cash. Accounts receivable is a type of an account that tells us that we're waiting to receive money. Well, why are we waiting to receive money? Well, because we performed a service on account. We performed a service without getting paid. We agreed to receive the money later. That's an accounts receivable. Companies will have supplies. Supplies tend to be used up quite quickly. Okay, and so, for example, I'll go to the most popular example of supplies is at your favorite coffee house, whether that's Dunkin' or Starbucks or some other coffee house is beyond me, but all the cups, all the lids, those are supplies for that company. No one goes into Starbucks and says, can I just have a coffee cup and a coffee lid? They don't sell that, they sell coffee. So they might give it to you, but they're not ringing it up as a sale. So usually those supplies are used to deliver the main product to the customer. So that's what a supply is really about. Things that the company uses to deliver the product or service to the customer. When a company buys insurance, that insurance, when you think about when you have car insurance, for example, most of you do. Well, if you're driving, I should hope you do. You're buying a policy for a period of time. You're not buying a policy for the day. You buy a policy for either a 6-month period or a year. So you're paying for a full year today. That's your asset. It's prepaid insurance. It's not an insurance expense because you haven't used it. In order to expense it, you have to have used it. And so, prepaid insurance is simply that. Insurance that has been purchased for the company that has not been used yet. That's prepaid insurance. And the last asset that's listed here is equipment. Equipment is a long-term asset, and meaning that the company's going to be using it for longer than a year's time. In many cases, several years, depending on the type of equipment it is. The next section of the balance sheet, liabilities and stockholders' equity, balances out the assets. As you see, the total amount of assets are listed here in this column, and they will equal the total amount of liabilities and stockholders' equity. Now remember, liabilities are things that we owe. These are debts that we owe to somebody. Stockholders' equity represents what the owners have either put into the company, which is their shares of ownership, or what their profits of the company have been retained. That's the retained earnings. So liabilities and stockholders' equity are always on the opposite side of assets. So again, liabilities, things that we owe. The word note in accounting and in finance is a loan. Okay. Most notes are short-term. Most loans are short-term. But you can have a long-term note. Accounts payable, and of course liabilities have the word payable is used in 4 of the 5 accounts here. But the word payable simply designates that we're going to have to pay. Just like the word receivable indicates we're waiting to receive. Okay, payable is we're waiting to pay. Well, why would we have an accounts payable? Well, because we have a bill that we owe. So once you get that electric bill from the utility company, well, now you now have an accounts payable. It has a due date on it. You owe it. Same thing with your phone bill, things like this. You owe it. You don't owe it prior to getting the bill. You only owed it when you get a bill. Accounts payable tend to be debts that are paid within 30 days, like a utility bill. Let me get to the other 2 payables before I tackle this very important account. Salaries and wages payable is just that. When you put your time card in at the end of your work week, most people are waiting until the next pay period to get paid. That might be a week later, might be 2 weeks later. But in the meantime, the company owes you that money that you've already worked for and put your time card in for. That's what a salaries and wages payable is. Interest payable is simply the amount of money that it owes on loans that's not due yet. Okay, but they're going to pay. So I want to tell you and introduce you to a very, very important account. It's a type of liability account. Again, liability is a type of account. Each of these are very specific liability accounts. But I want to talk about unearned service revenue. Now, the key is the word unearned, because service revenue, as you know from your income statement, is revenue. Well, why does this say unearned service revenue is a liability? Well, because of that first word, it's unearned. In order to be revenue, it has to be earned. In other words, you already have to do the work. But an unearned service revenue, you still owe the customer some type of work. So our company here, Sierra, does tours. So if a customer came and paid for the tour up front, and you owed that customer the tour, say next week or next month or what have you, well, you owe the customer a tour. Even though they gave you a bunch of cash, you still owe them the tour. And so this is where it would show up, unearned service revenue. is basically money that the customer has given us up front, and we owe the customer for whatever they paid for. This is a very, very common account, by the way, in big industries that are suffering right now, like the airline industry, hotels, sporting venues. We usually pay for these tickets up front. We usually pay for vacations, cruises, say up front. And then we take them whenever the date is coming. Well, all that money that we've given to the airline or to the cruise company or to hotels is unearned revenue. It's a liability to that company because they owe us whatever we paid for, whether it's a plane ride or a boat ride or a stay at a hotel. It's unearned revenue. So this is a very, very, very important account that you need to understand is a liability because we owe the customer what they paid for. And then a common stock, again, two different accounts that you'll always, so common stock is a type of account. The specific account, common stock, represents common shares of ownership. The word stock simply is synonymous with shares of ownership. So if you have a share of ownership, you have a share of common stock. And of course, retained earnings comes from our last statement that we looked at, the amount of profit that has been retained that belongs to the owners. So here you have total liabilities, total stockholders' equity that are listed. And as you see, these two total up to $21,910, just as the total assets are $21,910. So this is a very important, these are the three very important financial statements to know and understand. Because the balance sheet has assets on one side and liabilities and stockholders' equity on the other side, there's something called a balance sheet equation. It's sometimes called the accounting equation. But either way, it's assets equals liabilities and stockholders' equity. And that's very, very important to know.